a moment. That is, I didn't think upside was good on the day today. I actually thought that not only was there a greater chance that stocks would get faded today, but I actually advocated for selling call options because the volatility is so high. I have not seen the volatility this high in some stock option premiums in a while. I mean, you can make like 13 or 14% on some sold call options for 70 days. That is phenomenal volatility. And I'll show you the clip in just a moment, but look at this. If you go look at what happened to the Qs, we were up over 3%, and we ended up fading all the way down to negative 1.8%. That's almost a 5% move in the NASDAQ 100 intra-day. That is a shocking move. Now, let me go ahead and play the clip for you. Just remember, you could be part of what thousands, over 4,000 of you are watching on a daily basis in our private course member live streams. You can be part of it by joining the Meet Kevin membership. The price is going up on April 15th. If you lock in your price now, you will not have any price increase ever. You lock that price increase in forever. And anybody who joins after you has to pay a higher price. That's the way it is. So go check it out over at meetkevin.com. But here's the clip so you can get a glance. I don't want you to think like a retail investor right now. I want you to think like a money manager who doesn't want to get sued in the next crash. I want you to think like an institution or a hedge fund. Take the tactical rally and fade it. Because what has actually changed in tariffs? Nothing. What has psychologically changed? The words coming out of Bessent's mouth. Now, in pre-market, we've moved up to our next line set, 438, but I don't have anything for us past this. So I think it's a hard lift to say, oh yeah, okay, today we got to go calls on QQQ, because A, you're going into no man's land, and B, you're already extended up 3.6. So from a trading point of view, this is a very undesirable call position. Now, what I could consider would be sold options, right? Now, look, just because that was exactly what ended up happening does not mean I'm always right. And I want you to know my goal is to share perspective with you and with as much factual information as possible. I do want to mention that sometimes this pisses people off. For example, here's a tweet that I made on July 25th where I said, sorry, Tom Lee, rotating into small caps just as recession recession risks rise is fully R word, with some censorship here. Now, Micro to Macro says the only thing that is the R word is actually Meet Kevin, basically saying the Russell 2000 is doing just fine. Well, since these tweets, the Russell 2000 is down over 22%. Fundstrat in his fund, in other words, Tom's fund, has lost over 20% in his fund for his clients that he charges a large management fee for since just the election. It's not even a year-over-year performance. It's since the election. Now, it's not my fault some people don't position for protecting themselves when there's evidence of a recession coming. Ultimately, that is everybody's own desirability and their own moves. Everybody has to take responsibility for their own decisions. But I want you as an investor to consider what Barclays is telling you in their global macro thoughts. Don't catch a falling knife, because I understand how desirable it is to be bullish and to buy the dip. In fact, I want you to remember that the whole goal of Wall Street is to get you to put money in with their fund. That's Wall Street's goal. Wall Street does not want you to sell. Wall Street makes money off of you, whether the market's going up or down. And the more bullish you are, the more people invest with you. So remember, that is a risk factor. Now, what is Barclays telling you? Barclays, interestingly, has a research piece out suggesting that we now expect recessions in both the US and Euro area. This, by the way, comes just as JP Morgan is convinced we are going to have a recession this year, and JP Morgan says the Russell 2000 Small Cap Index is showing indications with a 79% certainty that we are going into recession. So in other words, small caps say 79% chance of recession. JP Morgan says yes recession, and now Barclays is joining the yes recession camp. Goldman Sachs is at about a 65% chance of recession. But I want you to look at some of the commentary they give, because I do think they give some really good insight here. They suggest that they do not expect a really quick walk back on tariffs, and that the president has emphasized tariffs will be permanent. He feels that if companies see tariffs as temporary, they will not move production back to America. Okay, there's a lot to unpackage here, and a lot of what there is to unpackage. Did you just guess that? Why would you say in your course member live stream the market's going to fade, and then it literally faded by 5% on the Qs? Huge move, by the way. Why would you make that decision?
Good morning, David.
Morning, Afila.
Should we grab coffee along the way?
Sure.
Okay, ready when you are.
Go. Hey, Afila, can you play my playlist?
You bet.
The reason I had that opinion was because what happened yesterday was a rebranding. Donald Trump is a salesman. He knows how to market. The problem with this is, what they found is they've changed the messaging on tariffs to try to reduce some of the damage of tariffs, but not the actual intentions. This is a big mistake in my opinion. See, what's happening is Howard Lutnick from the Commerce Department, which many people are now calling Nutlick because he's a yes man, or Slutnick because he never says no. These are very inappropriate. You should not say these things. Lutnick has actually been replaced by Treasury Secretary Bessent. See, Politico has a piece, which appears to be accurate, that Bessent flew to Florida to lobby Trump on tariffs. And basically, the article talks about how Bessent is trying to smooth over the tone of how they're describing tariffs to the American people and how they're trying to sell tariffs to Americans. The problem with this is, Steve Bessent himself says that he expects tariffs to be a melting ice cube. In other words, it's going to take a while, but eventually we're going to use tariffs to negotiate better trade deals with other countries and bring jobs back to America. Bessent is convinced that fired federal workers, imagine this, like imagine DMV workers doing this, okay, just as an example, but fired federal workers will end up taking jobs in American factories. Right, because we see that happening. No, we don't see that happening. But the point is, Bessent's messaging is, hey, we're going to negotiate to get that manufacturing done in America. That sounds positive. Lutnick's messaging is, we're not negotiating with anyone. We want our tariffs. That sounds blunt and harsh. All they've done is remarketed, rebranded how they're talking about the tariffs. They have not actually changed the fundamental basis of tariffs. And so when I was in the course member live stream this morning with thousands of you, I said, listen, I am of the mindset that this rebranding will end up getting seen. People will read it like a book and go, wait, nothing's actually changed. We haven't made a deal with Vietnam. We haven't made a deal with Taiwan. We've had talks. We've had concepts of talks with these countries. But we don't actually make deals. If anything, things are worsening in China. Don't even get me started on China. We still have to get through the Barclays recession piece here, but don't even get me started with China because that's going to be a big one here in just a moment. But a lot of this relates, like this sounds very Trumpian, what I'm about to show you. There is a transcript about a discussion between Gary Cohen and Donald Trump. Now, I don't know if it's accurate or if it's true, but let me just put it this way. It sounds like Donald Trump. Let me read it to you because I think it's going to give you a little bit more color into the mind of Donald Trump. It says, Gary Cohen, Mr. President, can I show you this? Cohen fanned out the pages of data in front of the president. See, the biggest levers of jobs, people leaving voluntarily, was from manufacturing. In other words, where were people leaving workforces in America? They were leaving out of manufacturing. They didn't want manufacturing jobs. Donald Trump says, I don't get it. Cohen tried to explain. I could sit in the nice office with air conditioning and a desk. Or I could stand on my feet for 8 hours a day. Which one do you do for the same pay? People don't want to stand in front of a 2,000-degree blast furnace. People don't want to go into coal mines and get a black lung. For the same dollar or the equivalent dollar, they choose to do something else. Customer service, IP work, legal work, accounting work, artificial intelligence development, doesn't matter. Trump wasn't buying it. Several times, Cohen asked, hey, Mr. President, Why do you have these views? Trump replied, I just do. I've had these views for 30 years. Kerry replies, that doesn't mean they're right. I had the view for 15 years I could play professional football. It doesn't mean I was right. Now, this is really interesting coming from Gary Cohn. What you find is the stubbornness of Donald Trump is probably exactly what's happening in the White House today. Now, people say, oh, come on, you know, he's a reasonable man. He's not going to be stubborn. Really? I don't know about that. Because even Elon Musk failed. And Elon Musk is pretty damn convincing. He's got a pocketbook. Look at this. Musk made direct appeals to Trump to reverse sweeping new tariffs and failed. This, by the way, was before Liberation Day. I'm not going to bore you with the entire story. It's obvious there was a failure. This is why Starlink and Tesla are begging for exemptions from tariffs on critical parts. For example, Starlink is begging for exemptions on Chinese machines so they can continue to manufacture the Starlink parts or the satellite parts that they critically need in their business. You have to think about it this way. SpaceX, or the Starlink division, they might pay $1 million for a machine, let's just say. But with that machine that they spend $1 million on in China, they might be able to do $10 million of business in the United States. What's their trade deficit, that company, what is, in that example, what is their trade deficit with China? They bought $1 million of machines in China and then sold $10 million worth of products in America. Well, technically, their trade deficit with China is $1 million because China didn't buy any of those Starlink units. But China enabled the selling of $10 million of revenue, or maybe even a lot more, in America through that quote-unquote trade deficit. But Donald Trump doesn't understand that logic. See, Donald Trump is of the mindset that a trade surplus or trade deficit is like a profit and loss statement. He said it himself. He said that, hey, what a trade surplus is basically like a P&L, and I want to treat it like a P&L. In other words, I want it to be positive. This is what he told us yesterday in his press conference. The problem with that, Mr. President, is it's not logical. It doesn't make sense because when you consider the example I just gave, you could actually import from China and do a lot more for the economy or global growth and have a technical trade deficit, but still be promoting the economy in a massive manner. See, Donald Trump sees a trade deficit as a loss. The reality is it's not a loss. And as a result of his opinion that there's a loss, he's refusing to negotiate with countries unless they give him even more than 0-0. China, the European Union, and other countries were all offering trade deals well before Donald Trump suggested Liberation Day. But he rejected all of those in favor of, well, Liberation Day. So, well, here we are. And so this is where we go into Barclay's piece and we look and we see Donald Trump feels that if companies see these tariffs as temporary, they will not move production back. That's where we left off on the Barclays piece. And that's exactly what's happening. Donald Trump is convinced through a misconceived notion that we must have a trade surplus with every country and we're going to sell them something whether they like it or not. This is being considered the reordering of global trade. And even countries that have no tariffs against us, like Singapore, are still getting blanket tariffs because Donald Trump wants more than 0-0. See, we had these positive suggestions over the last 48 hours that Vietnam would be a leader in global trade deals. But White House officials subsequently cautioned that did not mean the U.S. would drop tariffs on Vietnam. But there might still be permanent tariffs against other countries that do strike deals with us. And deals will actually look like, we're still going to tariff you, but we want us to do more for you. Well, what we're really doing here is rebuilding the entire existing global trade system. And it's no surprise that Barclays is now suggesting that the president is basically toying with a recession. In fact, if you just go to the bottom over here for a moment, you can see Barclays tells you the following. Barclays says, we expect the United States to be in a recession between Q4 2024 and Q4 2025, all year. They expect the Eurozone will be in a recession during that time. And they expect China's growth will not be 5%, but rather it will be 3%. They think global growth is likely to be near recessionary levels in the coming quarters. They also suggest that they like bonds as an investment. And they tell us that they think the earnings per share impact of tariffs and retaliatory measures are likely to be around 10%. Now, what's interesting is if you just consider 10% and you take a stock that's trading for 20 times, let's say $10 of EPS is $200. That's the stock value, okay? Very simple. Stock valuation 101. But the problem is it's not just EPS that gets hit, it's the valuation multiple. So instead of a 20x, we might be at a 16x. So now you take EPS down and you take the multiple down another 4 points, right? So if EPS instead of $10 is actually, let's say, $9, and we're multiplying at 160, that stock is now $144 instead of $200, which is a 28% drop. Now that's potentially just the beginning of the story because you could have compression much more than that, and EPS declines could be much more sizable in a recession. Something else to keep in mind is that the labor market is holding up and is being cheered by Donald Trump, but this is yet another mistake. Because as we know, and I've beaten this into everyone who watches my channel's mind, the labor market is the most lagging indicator of recession ever. Barclays actually does a great job here. They indicate that in 2009, let me see if I can find it. In 2009, the labor market has peaked at the end of 2009 at 10%. But the joblessness rate in September of 2008, right around the time of the Lehman Brothers collapse, was just 6.1%. In other words, the shock element that occurs in an economy doesn't necessarily align with when you get bad unemployment numbers. You usually get bad unemployment numbers after the shock event. And now that the 10-2 spread is over 50, we are ready and primed for a shock. And that's what's really scary, is we think the tariff event was a shock. The tariff event just lit the fire of the spilled fuel of the problems that our economy had going into this. Right? Donald Trump didn't solely create the conditions for a rough economy. You know, we didn't know we were going to have crazy tariffs like this last July. We were looking at a weakening labor market and the fact that this economy is not going to be resilient in the face of a bad shock.
To be free and flexible and creative was really essential to what I wanted to make, and I didn't find a platform that did that other than Wix. Hi, I'm Liv. I run Double Bricks, a print and design studio in Brighton, UK. I chose Wix for my business because of its massive scope for functionality and freedom of creation. Everything I create at Double is visual. So for me, those customizable elements like the hovers and the little animations, the additional bits of coding, the physicality of the actual process of printing really reflects me. From a business perspective, it was really exciting. Directing people to that site was going to give them everything that they needed.
And so it's no surprise that now all of a sudden you're seeing high yield spreads moving 93 basis points, which has only ever happened during major crises. I mean, look at the spike over here. We're still not at some of the peaks of some of the other credit events, but credit spreads are finally expanding. The largest credit spread expansion in 17 months. And this trend is just beginning. We're just at the beginning of this credit event. Don't even look at what's happening in like the CLO market right now. The CLO market, the collateralized loan obligation, this is different from credit default swaps, CDOs. The CLO market is seeing massive outflows because people don't want exposure to the loans of corporations that, could be small caps at risk of bankruptcy. I mean, this makes logical sense, but the problem is when the valuations of CLOs go down, the ability for companies to get financing goes down because companies rely on being able to get debt, access to debt from banks, capital from banks. But banks want to sell that debt. Let me clear this up, okay? So, see this cup right here? This is a pile of trash. See this wrapper? This is a loan from a crappy small cap company that's too over leveraged. Mind you, by the way, in House Act, there's a reason why we have zero bank debt, because we are very conservative, because we think the biggest money is made during recessionary times, and that's why I think a lot of people are investing with us right now. You can go check us out over at HouseAct.com, because we're probably a really good counter-cyclical play, and I have control over the business, and I'm really optimistic about it. But anyway, so here is a pile of crap, or a bundle of crap. We could call them tranches of craps. Boy, doesn't that sound familiar? Here is a crappy loan that is declining in value because the market is selling these CLOs off like crazy. So a new business comes along and says, hey, I want a loan. The bank goes, smells like crap, looks like crap. We'll just put it in the bundle of crap and hope it sells. If nobody buys it, the bank is there like this. Oh, we're holding all the crap. Please, somebody buy the crap. And the more the banks are holding crap that pops up out of nowhere, the more the banks are like, yeah, sorry, other business. We don't want to give you another loan because we're not going to be able to sell your crap loan because we're still trying to sell the other crap loans. And that's when you truly get to a real credit event where all of a sudden leverage and credit standards freeze up and banks aren't lending anymore. That's when you have a true collapse. We're not there yet. We're just starting to see the conditions of these things propping up. And these are things that most people don't pay attention to. I mean, if you look at the CLO market, Bloomberg just today, CLO ETF Bloomberg had a big piece on this. Cracks are forming. There it is. Now you can look this one up. I think it's a good one. Cracks are forming in the CLO market. Okay. Long and short, it's going to be harder for businesses and banks to actually lend to crappy businesses because nobody's going to provide liquidity through the ETFs anymore. Cracks are forming in CLO market as ETFs are on a record selling spree. These are the conditions for a recession. The fuel has been spilled. The fuel was spilled before Trump came along. Donald Trump just spilled even more fuel and lit the fire. Now we're waiting for it to hit the fuel tank. It's bad. We got to put this fire out. And maybe the thought is we could put this fire out with our negotiations with China. But let's put it this way. It ain't looking good so far. Now, people have this impression that China is panicking and that they're going to fold on, Donald Trump's demands. I don't see that as much as other people do. Now, it's possible that I'm wrong. Like I said, everybody can be wrong, but I want you to have my perspective on this because I'm very concerned about what's happening with China. China, first of all, is sounding more capitalist than I've ever heard them sound in my career, which is weird because I think of China as, well, frankly, the Chinese Communist Party because, well, golly, that's what they are. Why are they sounding more capitalist than us? As Donald Trump is trying to negotiate a trade deal with China, China is going to the European Union and promising close partnerships. They're not negotiating with us. They're negotiating with all of our allies. Japan, South Korea, Europe, everybody but us. Why? Because China prepared for this. There's all of the countries and blocks, because a couple of these are blocks, like the EU and ASEAN countries. Out of these blocks, the United States has the largest decline in trade in 2023 compared to 2022. Obviously there were other fluctuations going on in terms of deflation in China and also a slowdown in the Eurozone that had an effect on this. The United States was in a bit of a slowdown in 22, but started recovering in 23, which should actually mean the United States growth is even more positive.
Zero. Maybe
China
it was
is
you.
diversifying their exports to
Somebody
other
tried to say hello twice.